Hi, and welcome back to the Michael Yardney podcast. Over the past couple of years, we've witnessed a whirlwind of changes in our housing markets, and particularly in the mortgage market. Mortgage rates have skyrocketed at an unprecedented pace, soaring from around 2.9% in April 2022 to now, a couple of years later, staggering 6.4%. And if that wasn't enough, the rental crisis has reached new heights, with vacancy rates plummeting to record lows nationwide, causing rents to skyrocket. In the face of these mounting pressures, purchasing an apartment has emerged as a viable solution for many. After all, it offers an escape from the rental crisis and a chance to start building equity in a property for many first home buyers. However, this seemingly attractive option comes with its own set of challenges, and currently there's a severe shortage of apartments across the nation, not just for first home buyers, but for investors and for downsizers as well. So it's a topic that's been at the forefront of discussion for investors, developers and policymakers alike. So today, to unpack this further, I'm joined by Richard Temlett, the National Executive Director of Research at property consultants and valuers Charter Keck Cramer. We're going to be exploring the dynamics of the current apartment market, understanding the factors driving the shortage, and dissecting the trends both in the build-to-rent and build-to-sell sectors that you as a property investor, apartment owner, or just a real estate enthusiast should be interested in. So, let's get on with our show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Welcome, Richard. Now, I know your firm Charter Keck Cramer well because I've been using your valuation services for many decades, but can you please give us a little background for our listeners who don't know you or know much about Charter Keck Cramer?
Sure. Well, Michael, first of all, I'm a massive fan of yours. I've read a lot of your articles over the years, and it's a real privilege to be able to come on the show. In terms of Charter Keck Cramer, I've worked at Charter for a cumulative period of about 8 years in the research team. We are basically a multidisciplinary property valuation and consultancy business. We have offices in Melbourne, in Sydney, in Brisbane, in the Gold Coast, and also in Singapore. I work very closely with our valuations team, and that's the biggest segment of our business. But we also do property advisory, property research, which I'm heavily involved in, and then also quantity surveying services.
So I know Charter Keck Cramer keep a close eye on the state of our housing markets, and you regularly report on the state of the apartment markets. Your recent report highlighted severe shortages of apartments around Australia. Now, Richard, there's nothing new. This has been in the media a lot, apartments for sale or apartments for rent. But could you give us an overview of where Charter Keck Cramer see the apartment markets in Australia?
Sure. Well, we have a national apartment database where we track all the build-to-sell apartments and then also the build-to-rent apartments. So we get pretty good line of sight across all the capital cities as to what's happening in the apartment market space. Off the back of that, we prepare a 6-monthly apartment market report. It's freely available on our website, so I'd encourage your listeners to jump onto our website. You can download the report for free, and it'll give you...
I will leave a link in the show notes, Richard, so people don't have to remember how to do that.
Sure. Fantastic. Well, just then to answer your question, unfortunately, but it should be no surprise to yourself or to your listeners, that the apartment market, really both launches of apartments for sale and also completions, are at decade lows across the majority of the capital cities. And that's really worrying because we're now coming out of the pandemic and we've had record levels of population growth that's been the strongest since the 1950s. And the research in the report really shows that there's a very large mismatch between the demand for housing and the demand for apartments, and then also the supply of apartments. And that's going to probably remain the same for at least the next 2 to 3 years, quite simply because of the state of the apartment markets. And there are many, many challenges with both build to sell or build to rent projects actually getting off the ground, getting construction funding and proceeding.
Well, this hasn't happened overnight, has it? It's evolved over quite a while, almost a decade, really, if we look back, Richard.
It's actually two decades. You're absolutely right. It certainly hasn't happened overnight. It hasn't actually happened because of the pandemic. the pandemic has exacerbated a few issues, but unfortunately, when you look across Australia, you can literally go back 20 years to see where overseas migration policies were changed. But at the same time, governments in the capital cities were very reluctant to actually increase the supply of dwellings. And so it was building, where we had very strong levels of population growth and a lack of supply. And that's because of planning restrictions and a lack of sites being able to come to market in a timely manner. And then leading into the pandemic, we had a Banking Royal Commission, and we also had the government removing a number of incentives to incentivize foreign and local investors in the market and increasing taxes and charges on these foreign investors, which meant that even entering into the pandemic, supply was at decade lows. And then unfortunately now we've had the pandemic where borders were shut and occupier demand was knocked out of the market. And then we had interest rate rises, we've had building cost increases. And when I speak with a number of builders who have the privilege to work with or advise, they actually tell me that building costs on higher density apartment projects have increased by 40 to 60%, which ultimately means that a lot of the projects now that were basically bought or created in pre-pandemic times are no longer financially viable.
Well, that's scary because if one looks at the Australian Bureau of Statistics regular figures on apartment approvals, they're at very low levels as well, aren't they? So first of all, not many are being approved. But Richard, we know for the reasons you just mentioned a moment ago, in particular the costs, and they're not financially viable to build, most of those that are being approved aren't going to come out of the ground anytime soon.
That's a very, very good distinction to make, Michael. And unfortunately, a lot of what I see in the media really doesn't make that distinction. There's a big difference between a project being approved and a project actually getting sufficient pre-sales to then get construction funding from a financier and then to actually get built out. So what's happening now is that there are projects both before the pandemic or even now that have an approval either for build to sell or build to rent. But developers are very unconfident in terms of launching the project because they're very worried about having to increase apartment prices by around 30%. Because that's what they need to be compared to pre-pandemic levels. They're very worried about buyers actually accepting the higher price points. There are projects that are proceeding at those higher price points, but then you've got the financiers who are also very worried about building and build costs and whether builders are going to fall over. So we have a large amount of longer-term future supply, but what we define as short-term future supply, so that's projects that are launched to market for sale and projects that are then under construction and will be delivered in the next 2 to 3 years. That is actually at decade level lows. And that's extremely worrying because we have a housing crisis and a rental crisis, and the apartment markets have a huge role to play. They're not going to be the be all and the end all. There's still a very important role for the house and land markets to play, but the apartment markets have to play a role and an increasing role, and they're not able to do right now. And that's not going to change until the government, both federal, state, and local, actually start making various changes. And I'm sure we'll talk about what those changes ought to be very shortly.
Well, maybe we should just give some context to people who don't understand how the apartment market works. In the build to sell apartment market, developers take on a risk, but they also take on a lot of finance. And banks are usually not prepared to lend for new apartment developments until there's a level of pre-sales. In other words, assuring that the project's going to be financially viable. At the moment, as you're explaining, pre-sales aren't occurring or can't occur for many apartments because markets aren't prepared to pay what it would cost to build these new apartments out of the ground. Now, there's lots of different sorts of apartments, 1-bedroom apartments, student apartments, 2- and 3-bedroom apartments. And then there's the more luxurious ones that you used to call them downgraders, but right sizes use. Some are more profitable than others. There doesn't seem to be a profitability, financial viability at the lower end of the market. So we don't have developers able to take on the risk. And in the last cycle, there was a lot of overseas developers took on that risk. They're not at the moment, Richard.
Yes, that's exactly right. I suppose just to close out, your commentary about the apartment market, historically, it was much more of an investor-grade apartment market. And you're absolutely right. Developers would buy a site, they'd get a permit, they would then sell apartments off the plan to both investors overseas and local, and then also own occupiers. The banks are basically the gatekeepers of the finance, and the banks would read the markets. They would expect the developer to come to them with a bunch of pre-sales, which is basically evidence of market acceptance at those required price points. Where it's breaking down right now is the banks are going, well, we still need the pre-sales because it's very risky, but there's not market acceptance at those higher price points. What we are seeing, though, is that the market has evolved over the last 15 years, over the last 2 to 3 market cycles. There are more owner-occupier, and we call them right-sizer projects being delivered. That is basically to target the baby boomer segments of the population who are often very well off. They've paid off their detached dwelling. They're looking to downsize, age in place into a dwelling that more appropriately suits their needs. That segment of the market is still doing, in most sub-markets, it's still doing very well because those buyers have made a lot of money on their detached dwelling. They don't rely on finance, and they're able to pay the higher price points. In terms of whether they are being undertaken by overseas or local developers, you're absolutely right. Right now, it is more local developers doing it to local buyers. In the last cycle, the last boom, which was really between 2013 to 2020, a number of those projects were undertaken by overseas developers. A lot of them were even funded by overseas money, and they were sold to overseas buyers. But the overseas buyers had been removed from the market because of those taxes and charges and the removal of incentives. And also a lot of those overseas developers have, for one reason or another, whether it's developers from China who can't get their money out of China or need to repatriate their capital, they've actually left the market. So it's created a gap for more local developers who know the market very well. Some of them can't do the scale of the overseas developers could do, but also it's very risky to do that, as you've quite correctly pointed out. And if the market is there, but just it's stagnant right now because it's what we're calling or describing it as recalibrating, where buyers need to accept the new apartment pricing structure, which on all our stats show that it will actually be 30% above pre-pandemic levels when the market returns to equilibrium. But right now, we've almost got a bit of a standoff where you've got developers having to push up prices, buyers who don't want to pay those higher prices. You've got uncertainty with interest rates, and those buyers have had their buying capacity diminished by about 40% with all the rate rises. So there's so much uncertainty right now. Buyers don't know what they can afford. It's very confronting for them to have to take out less money, but then also pay 30% more for apartments. And that's really what's causing basically a bottleneck in a lot of the segments of the market, other than, as I said, the right sizer segment of the market, because those buyers are prepared to buy good quality product that is bigger than the investor grade product if it's well designed in smaller schemes in areas in which they want to live. But the investor segment of the market and the first home buyer of the market are either completely priced out of the market, or they're just sitting on the sidelines right now because of the uncertainty that we were talking about.
I guess there's another level of uncertainty as well. There's been a lot in the news, particularly in New South Wales, but in other states, about poor building techniques that occurred during the last boom, where shortcuts were taken, and a huge percentage of apartment buildings had problems, water problems in particular in New South Wales, cladding problems in Victoria. So I guess it scared some people off, even though it sounds like the next layer of construction is going to be done at a much better standard. But I guess this comes at an extra cost, Richard.
Look, it does. I do want to just clarify one point, Michael. When I've read in the media of the projects that have defective works or are leaking or are cracking, and we all know those ones because they hit the headlines, and that's a disaster for those buyers or the developer or the builder, but that's not reflective of the entire apartment market. And so I'd caution your listeners or the readers to just keep in mind that one or two bad apples are not a reflection of the entire apartment market. And I feel very sorry for some of the really good developers that have good brands, that are reliable, that have good builders, that have delivered stock for the last 20 to 25 years through different market cycles. They are still doing really well. And they unfortunately also now are getting tarnished with a bad reputation because they're tarnished with the same brush. In terms of your comments about increased construction costs because of better or higher requirements, that's absolutely correct. There's a national construction code that's requiring better built apartments. I think that, again, it's a good response by the government and the industry to a maturing segment of the market. So the new wave of supply will be better built. They'll have better warranties, and buyers should be they should take a lot more comfort in the fact that they're getting a better product, but they do need to be aware that with a better product comes a higher price. That's unfortunately the trade-off that has to occur. It is already occurring in the housing market and in the townhouse market with better quality product or designed product, but that is happening. Some of it is legislated by the government, but there's other developers that are actually going above and beyond that to protect their brand, and particularly focusing on things like passive house or various other construction techniques which mean these products are better built and will last longer. But again, it does come at a higher cost, as you said.
Well, the corollary to that, I guess, is that if you buy an established apartment, or many people own established apartments, there's huge inbuilt equity. Because I've been around the cycles a few times, and I know that I've seen this standoff, as you said before. Eventually, people are going to have to pay more. It's not going to get cheaper to build these apartments. It's not going to get cheaper to buy the land where these apartments are being built. And so, therefore, eventually the market is going to have to meet the higher costs. And that means people who currently own apartments are going to see an upgrade in the value of their dwellings as well. But we know the government's keen to build, 1.2 million dwellings in the next 5 years. They're not going to build any of them, are they? They're going to encourage developers to do so. Do you think this is going to eventuate? Will this alleviate the problems that we're discussing?
Yep. Well, look, there's a couple of comments I want to make, because I certainly agree with what you've said with the established stock actually repricing upwards. What we've found, and I work very closely with our valuation departments across the different states, they do a lot of valuations for the purposes of construction funding, and we've found that A-grade sites in prime locations are still increasing in land value, or at least holding their value. B and C grade sites have the potential to fall, and we actually surveyed the industry by perhaps 5 to 10%. I don't actually think that that's highly likely, given that there's such bad supply side constraints with planning. So you've got land values that are holding, you've got build costs, and I speak with a lot of the builders that have increased. They are stabilizing, but they're not going to go back to 2019 levels. So the economic cost of delivery, the land plus the build plus the profit that the developer needs to take on, means that prices need to be between 25 to 30% higher, depending on which capital city you're developing in. What we've found is that the unit markets, that's mainly older townhouses and established, recently built apartment stock across the different cities, is actually undervalued by 10 to 15%. When you look at the gap between detached houses and units, it's the highest it's ever been. And that's because houses grew with low interest rates and various incentives to help them be bought, whereas units did not grow, quite simply because a lot of the demand was knocked out of Australia. And I'll answer your question in a second, but what we feel is going to happen as the market over the next 12 to 18 months starts to recalibrate upwards, and it'll rely on interest rates stabilizing and interest rates being cut, and then the federal and the state government actually bringing back incentives for off-the-plan buyers, is that the established markets and established apartment and townhouse is going to increase by 15 to 20%. When that does actually start to increase, the new stock then, which has to be 30% higher right now, but it'll ultimately land on being about 10 or 15% higher when the market recalibrates. That new stock will then actually be attractive to buyers. The price difference won't be as large as it is now. Why I'll say all of that is because the governments at the federal level and in the states also at their respective levels have set that aspiration, and it is aspiration to build 1.2 million dwellings. When you look at the population growth, what's happened over the last couple of years and what is forecast to occur, we do need to hit 1.2 million dwellings, and that's around 80,000 per annum in Victoria, 75,000 per annum in New South Wales. However, when the team and I have actually analysed those stats, the peak years of supply, that's when greenfield market was going bananas, when the apartment market was going bananas, we didn't get anywhere near that level of dwellings. So even if the government turned on all the taps, we'd have to be building record levels of dwellings. And on top of that, so I don't believe they're going to turn on all the taps, because we've got federal and state budgets coming out soon, and I keep hearing that the budgets and the states are in deficit, so they're not looking to give, as they are calling it, free kicks to certain developers or the part of the industry. So hopefully we do get some incentives, but even if we got all the incentives, we'd have to build record levels of dwellings. We still would not hit those targets. You overlay the fact that the biggest risk for the industry over the next decade is actually going to be the availability of labor. My biggest concern when we start to quantify the number of builders in the market that can do greenfield development or higher density apartment development, a lot of them are no longer in the market compared to the boom of 2013 to 2020. A lot of them have either left Australia or unfortunately have gone into liquidation. So we actually don't have the capacity to build out that record level of dwellings. And that is a massive concern for me, particularly then with a lot of those builders that when I speak to, they're not even prepared to take on the high density risk right now, because they can go onto infrastructure projects that are more profitable, less risky, and are competing with labor and materials. So in a long-winded way to answer your question, 1.2 is a realistic target to meet the demand, but it's not a realistic target to hit supply levels. And it would take a concerted effort by the states to streamline and assist with planning, to remove a lot of those taxes and charges, and to incentivize the market. Even if they did all of that, they would still have to bring in skilled workers to actually build out these dwellings. All that leads then me to be very concerned that we're going to have an undersupply of dwellings. So we'll continue to have a housing crisis, continue to have a rental crisis, probably for the next decade. It's going to take another decade or so to get us out of where we are at. It took us 2 decades to get in. The way the housing market works is even if you change various planning schemes and you incentivize the market, the supply doesn't turn on immediately. It needs to then get built out. It needs to still work through different cycles. So it's going to take 1 to 2 market cycles, 10 to maybe 20 years to actually get to the level of supply that we need to get back into balance.
That's a sobering thought. So despite the will of governments to get home building activity moving, it just seems there's just too many obstacles in the way. The chronic trade shortage is very true. I was speaking to somebody only end of last week who manufactures home frames. He does 500 a year in regional Australia, and he can get the materials now after COVID. There just aren't enough tradies there. Then there's planning and licensing delays, more draconian industrial relation changes happening, material cost inflation, inefficient regulation, unfeasible lending practices. Boy, there's a lot of obstacles in the way, aren't there?
There are a lot of obstacles, but I must admit, I also choose to be positive, and I still believe that a lot of those obstacles can actually be overcome. It's not going to happen overnight. I have the privilege to present to whether it's the RBA or to different levels of government, and certainly there are a number of tools and levers that the various organizations or governments can actually pull to start to stimulate the market. But again, they've got a timeline of 5 years, or in Victoria it's 10 years. We actually need to have an even longer timeline than that, because as you well know, and as your listeners well know, the market moves in cycles. So even if it's 80,000 dwellings a year in Victoria, or it's still there'll be years where we go higher than that, or years where we go lower than that to get to the 80,000 dwellings. Your comment about materials is well made. Those are more available now. Prices are stabilizing, other than for concrete. It is the capacity of the industry to build the projects out. Again, Australia is a very attractive place to live. And whilst we do have a very good and strong or responsible level of skilled migration and overseas migration into Australia compared to Europe, for example, which does a lot more humanitarian visa approvals, I still feel that there's an opportunity for the government to actually bring in more skilled, just incentivizing the workers in these trades to come into the country. And there's a number of things that I can actually do. For example, recognizing TAFE qualifications, for example, in some of the visa applications, and get people to come into Australia, which is one of the most amazing countries to live and work in the world. And if we get that right, and the government actually takes a longer term view, stimulates supply, they can tax that supply when it gets built on the back end. And the reality is we've come out of a pandemic, and I keep talking to everyone in the industry about drawing similarities to World War II. When we came out of World War II, obviously I wasn't alive back then, but when Australia came out of World War II, they put in emergency measures to build us out of that doldrum that we were in. And if you look at the stats, it took 20 years to get us out of there. And that's the same sort of thing that I think the government, the lens they need to view it from or through. The reality is we're probably going to have to go into more debt. Whether you agree with some of the pandemic measures put in place, where we are now is we are in debt, we have a deficit. But quite simply, housing is a very important part of the Australian economy. It needs to be stimulated. It needs to actually be built out. And I'm still convinced, I'm sure there are people in Treasury, both at the federal or local level or state level, that can actually look at the financing and get new stock built out, change the tax system so that once stock is actually delivered and people still have jobs, tax it in a separate way to actually start to raise revenue. What I'm trying to just articulate is that I do believe that a lot of this can be done. And even if we don't quite get to 1.2 million dwellings, it doesn't mean that we should just, throw our hands up in the air and just give up, which I do worry sometimes that when I read these headlines, that potentially might be the government response, which I don't believe is an acceptable response. And I don't think it has to be that way.
I agree with you, Richard. Interestingly, when we talk about the lack of tradies, I think one of the other things that's exacerbating that is that very few Australians are going to tech. They're not going into trades. We're becoming more a knowledge-based society. So I fully agree with you that we've got to import them from overseas. Now, one of the new trends that's happening in Australia that's been going for quite some time is the build-to-rent market. Build-to-sell we've already spoken about. In other words, developers buy land, pre-sell some properties, then start building their developments and sell them to owner-occupiers or investors. But for those who don't fully understand, the build-to-rent market is where developers are encouraged, corporations, locals and overseas, are encouraged to build complexes that they hold on to for the long term, giving long-term rental accommodation. It isn't as financially viable as other commercial options, asset allocation, and that's why many superannuation funds and developers aren't doing it. But the government has now come up with some ways of incentivising them, wanting to encourage the build-to-rent segment. Richard.
Yep. Look, a couple of comments with that too. Build-to-rent is emerging in Australia. It has already emerged in the UK. It's about 15 years old, and it's about 30 years old in the United States. It emerged because the government actually put in place incentives to incentivize development. For your listeners, it's less profitable, but also arguably less risky than build-to-sell. And by that I mean, typically with build-to-sell, you'll build the stock, you'll sell it. There's very high levels of peak debt exposure. You sell it down, you settle, you get out. Whereas with build-to-rent, people actually need to view it from a cash flow perspective. They need to view it much like an office building or a hotel building, and it's actually lower risk because rather than having like even in an office building where you might have 5 tenants, if you build 200 apartments, you've got 200 streams of income. So it's much more of a defensive asset class and probably people really appreciate. And
it's a long-term
part of the reason.
way of thinking, of course, isn't it? While many developers are aiming to trade and make profit that way.
Yep, it is. And why I'm just starting to articulate that is because it's become very clear to me that the asset class is still emerging, and the financiers in Australia don't yet understand it. And that's not a criticism of them. It's the same thing happened with student accommodation back in the early 2000s, where that was emerging, and also finance didn't truly understand it or wasn't able to truly price the risk. And it took the same sort of thing in the UK when it emerged. And that's what's happening now. We're going through growing pains. There's not many assets that are actually operating or fully stabilized, and none that have properly traded yet. So finance can't price the risk. And as a result, the fundamentals exist in Australia for build to rent. And when we look at the take-up of apartment living, we look up at the take-up of renting and longer-term renting, those trends show that there is a strong take-up, especially in Melbourne, Sydney and Brisbane. The finance just needs a bit of time to understand how to price the asset, and it'll be a bit differently priced compared to overseas jurisdictions because there's slightly different living preferences there, different tax settings, different financial structures. But that market has started to emerge. It does have a role to play. Don't believe everything you read in the paper that all that pipeline of supply that's coming on board right now is actually going to be delivered. Your comments about stock at the approved stage also applies to BTR. Just because you've got an approval for BTR development, it doesn't mean that it's going to be able to get the funding, whether it's debt or equity, to actually proceed and get built out. And what we're finding now, I have the privilege to actually present to a lot of the overseas funders. And the overseas funders are basically teaming up with local developers. The local developers know the market on the ground. The overseas funders understand the finance a lot more. The overseas funders, compared to 12 months ago, or even the local funders, are prepared to provide debt, but they're just on much higher interest rates because of interest rate rises. The issue is that they're reluctant to provide equity at the levels that the equity is being provided, or the returns that they were trying to get 12 months ago. And as a result, BTR is very capital intensive. You basically put your equity and your debt into an asset, and much like an office building, you hold it over a period of time, whether it's 10 years or so. And the returns right now, the equity returns that the financiers want, are not really commensurate with where the market is at. And so a lot of that stock, even though there's the market fundamentals to support it, the finances don't support it. The finance does not want to take on the development risk, particularly now because of construction costs and the risks in construction. And so a lot of those projects are not yet proceeding. But when I look into the future, it's going to take 1 to 2 market cycles for the asset class to properly actually emerge and finance to understand it. And then also for the renter population to actually understand the value proposition of having BTR, which would be things like secure rental tenure, being able to customize your apartment, keep pets in it. When they understand that value proposition, it's highly likely that they will pay a rental premium for the stock because it's the privilege of having the benefits compared to private rental accommodation. That asset class will actually play a significant role in the housing market. In terms of how big, I'm not quite sure. I do see some of the commentators trying to quantify the depth of the market. I've deliberately tried to steer away from that because when I've seen a lot of the analysis, it's not the market never works in linear amounts. It goes in as per the market cycle, and institutional capital is looking for diversification aspects. I do feel that the superannuation market will get into the housing markets and fund housing, and it can play an important role and has to play an important role over the next decade or more. And it'll be interesting. I chat with some of my friends or colleagues, and we actually think that in 10 to 15 years' time, kids and grandkids will actually, a lot of them will be living in BTR almost as a norm, because just the way the housing market is going, it's going to be very difficult to raise a 20% deposit for a house. And even apartments, they will become mainstream. A lot of people will buy apartments, but many more, the sad reality is, unless the government actually really stimulates the market from a supply side, a lot of them will be destined to rent and rent for longer term. And so whilst perhaps a lot of the discussion today has been rather negative in the short term, there's significant opportunities for financiers and developers who have well capitalized balance sheets who can actually proceed in current conditions, build out their stock, because there's going to be very strong rental growth over the next couple of years, because most of their competitors cannot deliver stock right now because they can't get the funding. So there'll be a fast take-up, there'll be strong rental growth, there'll be strong pricing growth. And I do believe over the next 4 or 5 years, there will ultimately be a supply response. How quickly that occurs comes down to the government.
Well, you mentioned that it's negative. I think we're being realistic with what's going on. I'm not negative about the apartment markets. I'm sure that over the future, more Australians are going to trade backyards for balconies and courtyards to live in the right locations, to live in the right neighbourhoods, as happens in all the big cities around the world. There are just some challenges moving forward, and the build-to-rent segment definitely will have its place, but it's not going to be providing the affordable or social housing that the government would like it to. It's just too expensive to do it that way, isn't it, Richard?
Well, to be honest with you, I've studied the markets overseas, both in the UK and the US, and typically the initial phase of BTR, yes, it does come in at the upper end of the market. There is a very significant rental premium. They often have all the amenity, all the bells and whistles, but there's a very deep mid-market in the UK where basically a lot of that stock is actually coming in at not much of a premium compared to the private rental market. And I actually feel that as the asset class matures, there will be different segments of build to rent. There'll always be the upper end where the high income earners can pay the premium. But I actually feel there's a very deep market for mid-market build to rent, and potentially essential workers could live in some of that. But there's a distinction between essential workers and I suppose what the government's calling affordable housing or moderate income earners, where basically the weekly rent is capped. And what I keep advising the government and talking about is that affordable or social housing actually needs subsidies. It will not naturally be delivered. The government and the Brisbane Council's done a couple of these where they've actually provided subsidies for BTR so that some of the key workers or essential workers can actually live in those buildings. But I suppose in a roundabout way, it'll start out with the higher end stock. The analogy I use is much like the Apple iPhone. If you remember back in the day, the first iPhone came out, it was exorbitantly expensive. As people understood the product, it actually segmented, and there were different levels or different tiers of the iPhone. I really feel that the same thing happens in the apartment market now. If you remember 20 to 25 years ago, there were some very high-end apartments that came out. There were some investor-grade stock that was at a different segment of the market. But when you look at that and you fast forward 15 to 20 years to where we are now, there's different segments of the build-to-sell apartment market. I feel that there will be different segments of the build-to-rent apartment market. But as it comes to affordable or social housing, the government has a role to play really in subsidizing some of those weekly rents, because I don't really see many ways that can be financially or feasibly delivered without some sort of a subsidy, because the financiers do not want to be leaving money on the table, which they effectively have to do by providing rental stock below market rates.
Well, I believe the government's responsibility is to help disenfranchised people. There's always going to be some of those, and that's what we pay our taxes for. But I appreciate the feedback and the information you've been giving us. Maybe just to finish off, based on your expertise, what's your long-term prediction for the Australian apartment market? What are we going to be talking about in a decade's time when we have a chat then?
Well, look, I certainly hope that we're chatting in a decade's time, and I certainly hope that I'm still studying the apartment market, which I think will be playing a much more significant role than it is now or than it has historically played. When you look at the stats from the census, 20 years ago, apartments were a very small percentage of the total dwelling stock in Australia's capital cities. And really, people only lived in them as a form of rental accommodation, as they say, for a deposit to then buy potentially a townhouse, but mainly a detached house. You fast forward that 15 years, and you can actually see that there are a number of segments of the market, particularly the millennials and the baby boomers, that are actually at different points of their lives choosing to live in apartments, either for sale or for rental. When you look at a lot of the strategic plans by the different cities for the growth of those cities, they're actually acknowledging that what's been built in the past is very different to what is being built into the future. Now, I'm not saying everyone's going to live in apartments. I'm not saying everyone's going to live in build to rent, because there'll still be a very important role for townhouses and for house and land to play. But I would suggest that in 10 years' time, there's going to be many more apartment submarkets and apartment projects in Sydney, Melbourne, and Brisbane because of affordability issues, because we're running out of land in a lot of those cities, or we do need to an extent go upwards in certain areas, because those areas are often they have the highest levels of amenity, retail, transport. And I feel that both build to sell and build to rent will continue to segment. It'll be much more mainstream, much more owner occupier. Builders will have to step up and do better built and better designed product. They're already doing that. There will be different levels of apartments. There will be different sizes, and apartments will help with housing affordability, not because they're cheap, but because they're more affordable in townhouses, because they're more affordable in house and land. And we can't keep building outwards. We can't keep just building house after house after house, because that's not necessarily what every segment of the housing market wants. And apartments offer a very attractive entry-level point for people moving out of home or downsizers. And I'm a very big advocate for actually giving diverse dwellings, giving choice for people to live, let them choose where they want to live and the types of dwelling they want to live. And I suppose then, just to round that out, if I was in finance, if I was a developer, I'd be extremely bullish of the apartment markets. Pick and choose the locations, pick and choose your brand, but there's a huge role to play. And the good developers and financiers that are doing apartments are in many respects ahead of the buyer market. And Steve Jobs actually made a very, very good quote that's always stuck in my mind, where I think it was with the iPhone, where he said something along the lines of, how do people know what they want when they haven't even seen it yet? And in many respects, I'm starting to see that with build-to-rent apartments, or even the really lovely higher-end build-to-sell apartments. You see the product be delivered, and all you need to do is look overseas, and you can see some of it being delivered. And not everyone's going to live in apartments, but there's a big segment for various reasons that will live in apartments. And the challenge for the development industry is to deliver that product. And then the challenge for the finance industry is to actually provide a financing package or product that can finance the delivery of these projects. And I think gone are the days of the financing investor-grade projects where you need to get 70% pre-sales. Quite simply, the buyer demographic that buys and lives in the apartments in the right size segment of the markets want to actually touch and feel the products, and they don't necessarily understand size. They want to walk through the project. They want to see how it looks and feels, and then they can buy off the plan. And so I speak to a lot of the financiers and have challenged them, obviously in a good way, and I'd love to talk with them more about it, about coming up with a different financing model to allow some of the projects to proceed with low levels of pre-sales, and then allow the developers to actually build the projects out, increase prices, because my experience is a lot of those right sizes are very slow to buy off the plan. Often they buy when the project's under construction or settles, but they settle very quickly and they can pay a higher price if you take them on the journey. And so the financing model is actually not fit for purpose. I think it needs to continue to evolve. I suppose that's all I'll say about it for now, other than the fact that there are significant opportunities in the higher density market, both build to sell and build to rent over the next 10 to 15 years, which is what developers and financiers need to be looking at. If they're getting sucked into the headlines over the next 6 months or the next year, I think they're taking their eye off the ball. Property development in particular is a long-term game. You should be doing it over 1 to 2 market cycles. Investment, I appreciate, is a different story, but for the developers, they should look at the tailwinds. They should look at the investment thematic across the capital cities, see they're very strong, and they should take that longer-term view.
Well, if you came to Australia today and hadn't been here for a decade and you went to any of our big capital cities, you wouldn't recognise the landscape. And I'm sure it's going to be the same in a decade's time. And who knows, maybe we'll be chatting then too. Thank you so much for your time, Richard.
Thank you very much for having me, Michael. Chat to you soon.
I hope you enjoyed my chat with Richard Temlett, and I hope you can also see that there are opportunities in the markets at the moment. Oh, by the way, if you got benefit from my chat, but don't currently subscribe or follow this podcast, just stop for a sec on whichever podcast app you're listening to and follow the show so that twice a week you get information from my guests and me. Now, while some markets have outperformed really strongly over the last couple of years, many have had double-digit growth. Are you ready for what's ahead? I think you would have heard and got the message from my chat with Richard that over the next few years, the markets are going to be very, very different for property. And if you're an investor, you may have to change your strategy to cope with this new environment. So let me help you. Why not turn to the multi-award winning team at Metropole for independent, unbiased property and wealth advice? We're much more than just buyer's agents. We help our clients safely grow into generational wealth through property. Oh, we're big enough to tip the scales in your favour, but we're still small enough to care. And whether you're just starting or whether you want to grow your existing portfolio, let my team help you. I've fine-tuned frameworks over 5 decades, and the team are sharing that with you and our clients, where we've been involved in over $6 billion worth of property transactions. And we've got on-the-ground experience with our own offices, our own teams on the ground in the 3 big capital cities. And since we don't sell property but have access to every property on the market, we can help you. Metropole.com.au. I'd love to be part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
My mindset message to you today is that you're a miracle. There are roughly 7.7 billion people in the world today. Imagine the world's biggest lottery, in which every one of us is required to draw a ticket with the circumstances that we're going to be required to live in for the rest of our lives. For example, are you going to be male? Are you going to be female? Which country are you going to be born in? What type of government are you going to have to suffer? What are your parents' income levels? What are their occupation? What's your IQ going to be? Remember, you're going to draw a lottery ticket that's going to tell you what your life's going to be like. Your height, your weight, your eye colour, your hair colour, your body type. It's going to tell you what your personality traits are, your temperament, your wit, your sense of humour, the level of your health. Now, if you're listening to this, I'm guessing you drew a ticket when you were born that wasn't too bad. The probability of you drawing a ticket that has the favourable circumstances you're in right now is incredibly small. In fact, I've read that the probability of you even existing comes out to 1 in something followed by 2 million zeros. I don't fully understand how they work that out, but the chance of you being alive, being who you are, I guess then means basically 0. In other words, you're a miracle. Warren Buffett often talks about how grateful we should be for all the circumstances we're born into and the generous ticket we've been offered in life. He says we shouldn't take it for granted or think that it's the product of something we did personally. We just drew a lucky ticket. He points out that his skill of allocating capital would be totally useless if he'd been born into poverty or at the time of the American Civil War. Yet most of us are too quick to complain about the traffic on the way to work, or the weather that's going to spoil the sport or the weekend, or ungrateful clients that you've got, or customers that you've got, or your boss, or people we've got to deal with. I guess many of us suffer a self-entitlement syndrome. Entitlement gets us nothing but heartache. It blinds us from the magic of gratitude. And you've heard me talk about gratitude before. And most of all, entitlement lets us off the hook, pushes us away from taking responsibility and action and towards apportioning blame, anger and self-pity. On the other hand, gratitude, that's just as valid a choice, except that gratitude makes us open to possibilities. It brings us closer to others. It makes us happier. So I want to finish this mindset message with a simple life hack. You're not grateful because you're happy. You're going to be happy because you're grateful. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports, my way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?